Welcome, everybody, to our webinar, The CFO's Guide to Smarter Financing. I'm Rocky Gor. I'm founder of CAPX. I've been in the world of lending for a long time. Some of you on the call have known me. I started at GE Capital in the year 2000, was there for a long time, and then I was at Wells Fargo for a while, and that's where I ended up working with Scott. So I've spent, formative parts of my career in corporate finance, and that's how I ended up creating CAPX and launching CAPX, which is a platform to connect companies that need financing, and we connect them with lenders all across the country. Scott and I have known each other for a long time. He's on our team. Scott, tell us a little bit about you and your background, and so people know where you come from.
Yeah, thanks, Rocky. So my career's been 35 plus years in corporate lending, working for commercial banks, largely Wells Fargo, as Rocky mentioned. Worked on structuring and executing a variety of financings for middle market companies, both private companies, public companies, private equity-backed companies, in all kinds of situations, such as acquisition financing, growth financings, recaps. And in the course of all that, have spent a lot of time looking at and working on different types of financing structures, some of which we'll definitely be talking about today, and have worked alongside many different lenders of different types to put solutions together for companies. So excited to have this discussion, Rocky, and looking forward to it.
So I guess the way we're going to take this, Scott, is, you and I are going to have a conversation. And the way we want to discuss this is how lenders look at financing. So when companies approach lenders, they have a much better idea of, the way to look at their company, the way lenders look at them, and then how they can end up pitching them appropriately so they can get financing much more efficiently. When we started thinking about the webinar, I don't think either of us thought about what's happening today or what happened yesterday, the tariffs. But I think one way or the other, I think our timing is pretty good in that regard because of this uncertainty of the tariffs. One way or the other, companies just need the liquidity because there's no way of predicting what's going to happen after 3 months or 6 months or a year. So the only way you can get around this is to have more liquidity. And if you want more liquidity, then one way or the other, you're going to go and get some type of financing. So this could be a good timing to talk about this.
Yeah, the timing is pretty incredible. I agree 100%. I mean, no one, if I'm the CFO of a company right now, it's very hard to predict what's going to happen with the economy and with your particular business, with the tariff environment over the next 6, 9, 12 months. So what you want to do is prepare yourself for any eventuality, good or bad, by amassing as much liquidity as you can. Yeah. I mean, to me, that's the solution. And that's, really what we're talking about today.
So in one sense, I mean, there's a lot of negative press about tariffs. The demand will go down, people will buy less, the price will go up, and all those things are possible and true. And some companies might need liquidity to deal with all those negative outcomes. But then if you look 6 to 12 months ahead, it might end up benefiting some of these companies if these tariffs persist. So for example, if I'm a supplier to, the top auto companies in the US, and the end result of all this tariff work is, more manufacturing is happening in the US on the auto side, then if I'm a supplier, it could be an opportunity for me to supply more, and I might need more capital to put up a new plant. So for negative reasons, you need to think about this, but also potentially, 6 or 8 months or 12 months down the line, you need capital to grow. And that's probably another reason why we want to talk about, how to get more liquidity today.
Yes.
And I think if we start thinking about how lenders look at this, then I think, kind of the step one in the process as to how should a borrower think about, going for financing. The step one, if I'm a lender and the deal comes to me, the first thing I think about is, okay, if they want this type of money, for whatever reason, if they cannot pay me back, how am I going to get this money back? And for that, I'm going to rely on some asset, some value, some collateral. So any lending, obviously, is always going to be a loan to value type of analysis. So if I'm a CFO, the first thing I want to think about is, what is my value? What value I'm offering to the lenders that they can take that value, discount that, and based on that, they give me the capital. So if you look at the value perspective, from lenders' point of view, more comfortable they are in predicting the value of that collateral, less is the risk for them, and thus the pricing is less. So if you now think about a company, what collateral they can offer to a lender that would have, the highest predictability in value, all your current assets, probably your M&E, probably your real estate. So hard assets as well as current assets, basically, they give you this ability to predict the value much more comfortably, and that's why those are probably the least risky structures, and all financial institutions want to do that. So that's kind of the one way of thinking about, do I have these type of assets, and if I do, can I structure a financing around that, and can I give that to the lenders, and they can end up giving me the loan that I'm looking for. The second way to look at that is, if I'm a company that doesn't have a lot of hard assets, so I need to go beyond the value of the assets, how else can lenders look at that? So then lenders look at the enterprise value of the company, and they are thinking about, well, this company is so successful, it has been generating cash flow, so it has certain enterprise values. In the worst case, there's always going to be a buyer for this company, or there's going to be demand for this enterprise. So I can look at the value of the enterprise and I can discount that. So, for example, if a company is valued at 6 times EBITDA, 6 times multiple of EBITDA, that's the enterprise value of the company. A lender can look at that and say, okay, I can give up to 3 times EBITDA of this company as a loan. So I'm discounting the enterprise value by 50%. So that's my loan to value discount. And now I can give the loan at 3 times EBITDA. So now this is basically a loan that is focused on, company's ability to continue to generate the cash flow. So we call this a cash flow loan. So that's kind of another way of looking at company's ability to obtain debt. And that's kind of the other angle companies can take when they are trying to assess what is the value they can offer to the lenders.
Rocky, maybe beyond going one step beyond just what the basic structure might be best for your company, whether it be an asset-based approach or cash flow, what are some of the other factors that companies should be thinking about as well as they think through their structures?
Yeah, one of the first things is, if my business is working capital intensive, do I need working capital line? And if I do need working capital line, what is the best way to obtain that? Second could be, I might be a CAPX heavy company and I need the ability to kind of, buy and sell equipment, or, kind of do certain CAPX. What is the type of financing that would allow me to do that, much more readily? Another thing could be ongoing administrative issues. Some loans require a lot of maintenance, you need a lot of reporting, etc. Do I have the infrastructure? Do I have the people who can continue to do so? If I'm going to be an acquisitive company, would this lenders be able to support me if I need to get more money down the line, or I'll have to go and find somebody else, so on and so forth. So there are so many of these strategic issues that come into play, in addition to what is the structure, what is the pricing, how many lenders are available. You should also think about all the strategic issues, and then think what is the right approach, and then go to the market.
Yeah, most of these facilities are multi-year, so you really got to be thinking medium term about what your needs are going to be and what fits best, I think.
Absolutely. And then when your needs do end up changing, how easy or difficult would it be to go to these lenders and request for a change? For whatever reason, for example, tariffs came in or tariffs are not there. And how easy or difficult would be to work with these people? What would be their approval process, et cetera? And so that kind of brings us to the last point in the cycle here to decide which path to pursue is, once you understand your value and you figure out what is the best way to monetize it based on the value of the assets or based on the enterprise value, and you think through your strategic needs, then you kind of start targeting what are the right lenders. And fortunately, today, compared to 2008, when we had the financial crisis or credit crisis, there are so many choices available now, way beyond the banks. You can obviously go to the banks, but then you can also go to many, many non-bank lenders. So it's very important to understand, what is your value, what is the structure you're pursuing, and then look at the group of lenders. Otherwise, you may end up we're seeing wrong set of lenders and end up spending a lot of time, chasing them and might not get the solution that you're looking for. So with that, let's just start getting into each of the structures in a little bit more detail and talk about how they work. So let's just first start with asset-backed structures, Scott. So let's discuss asset-backed structures. With what type of companies are suitable for that, and why should they think about the asset-based structures?
Yeah, obviously it's in the name, but companies that have balance sheets that are asset heavy are obviously going to be candidates of an asset-based loan. If you're sort of an asset light business, you probably won't get the leverage that you would want. So, but if you are, a manufacturer distributor that has a good balance sheet, you definitely want to consider asset-based lending, and just beyond debt capacity, it is probably the cheapest cost of capital you're going to get. And it's a pretty deep market. Almost all banks have some ability to lend on an asset basis. And then you've got a whole array of non-bank lenders as well that are in the asset-based world. So it's a deep market. And I guess maybe the next thing to talk about is just how the process works
Let's first talk about the structure, what goes into the asset base, what type of assets, how lenders look at that, and how it is structured.
Yeah, sure. So, typically, it's going to be a current asset driven facility. So you're going to have receivables and inventory, and you're going to get the lender's going to come in and assess your quality of your assets and come up with advance rates against your receivables, generally anywhere from 75 to 85, even 90% advance rates can happen. And then on inventory, they're going to look through, and often they'll hire a third party to come in and assess the market value of that inventory if it's not something or the bank has had a lot of experience with.
Sure.
And then they'll come up with advance rates as well. And, you put it together and you create the borrowing base that's going to sort of dictate what the debt capacity is under the asset-based line. And a lot of times, most of the time, they are structured as revolving lines of credit. So it's a facility that's very flexible. You borrow against your assets when you need it, and you can pay it back when you have the cash flow as well. So it's very flexible in that sense.
So then how about, and a lot of our participants might know all these fundamentals, but can I get into some details? How about fixed assets, machinery and equipment, real estate? Obviously, you can have term loans, based on M&E and real estate, et cetera. But how about trying to include machinery and equipment as well as real estate in the borrowing base in terms of line of credit? How would that work, and kind of pros and cons of that versus doing a separate term loan?
Yeah, you can absolutely include fixed assets, meaning primarily real machinery and equipment and real estate in the borrowing base. Not every institution has the same appetite for it, but it can be done, and it's a similar process in that the lender is going to want to assess the value of that equipment or real estate. They may bring in third parties to do appraisals, and then basically it becomes part of the borrowing base. So your borrowing base expands with the value that is determined on those fixed assets. And then there's an amortization that's assigned to the fixed asset portion of the borrowing base. So it could be 5 to 7 years on equipment, could be 10 plus years on real estate. But the difference being from a funded term loan is its availability, its debt capacity, but it may amortize, but it may not. It doesn't have to be a cash payment like a funded term loan, because if you're not fully borrowed, then it's really a reduction in your debt capacity as opposed to your actual cash outlay. So can be.
One way to think about this, if I'm a company that is replenishing the M&E stock on an ongoing basis, right, then this may end up being a good solution for me, because I'm getting rid of old equipment, kind of getting the new equipment, and this borrowing base ongoing basis continues, and my availability most of the time will remain within a certain range. Versus if I had a term loan, then I might have to do amortization, and then I have to amend it to kind of put in more equipment, et cetera.
Yeah, that's right. There's a little wrinkle or nuance in that a lot of lenders do not like their borrowing basis to be super heavy in fixed
Mm,
assets. So
right.
if you start getting past, say, 35, 40% of your total borrowing base in the form of fixed assets, you're probably going to get some resistance from your bank lender. So, but if it's a funded term loan that's sort of a separate standalone, they may have more latitude. So you kind of
Mm.
want to look at both options to see, if you've got the cash flow to service a funded fixed asset loan, then you want to look at both options, I guess.
And then, so this ends up serving as a good alternative to like your standard CAPX line. You can just use your line of credit to do the same thing to finance ongoing capital expenditure and growth.
Yeah, and a lot of banks will, or ABL lenders will structure separate CAPX facilities. So it's sort of like having a ready-made availability to go out if you need to buy equipment. It's already pre-wired into your loan docs, and you don't have to scramble. So it's that is also a good feature to think about if you're a company that's frequently in the market buying capital equipment.
yeah. So then another, I think, feature of ABL is lenders are focused primarily on the value, then your covenant packages are supposed to be pretty light. So primarily just fixed charge coverage, right? And then there could be tiers as to when they are being measured.
Yeah, and in some instances, as long as you maintain a certain amount of defined liquidity or availability in the business, you may not be tested at all in covenants in asset-based lending structures. Depends. If you have a lot of amortizing assets like fixed assets, that may not apply. But if it's a pure working capital line, that could very well be the case.
So then um, let's talk a little bit about the non-bank lenders that have entered the market over the last few years. How to look at them. What do you, if I'm a CFO trying to get an asset-backed financing, why should I approach a non-bank lenders? What can I expect from them?
Yeah, the non-bank market has grown significantly, and it's what the thing to remember is they're not regulated the same way as commercial banks are. It's so that consequently there's a lot more flexibility in what they can do and how they can structure. That oftentimes they're willing to advance a little higher on the assets. They're also willing to look at more non-traditional assets as eligible collateral.
Mm.
Um, they're their monitoring can be more flexible, their ongoing monitoring. So there's a lot of positives to looking at the non-bank world. Obviously, the flip side is their cost of capital is not what a commercial bank is. So you're going to pay a premium over a commercial bank line. But so you have to, as a company, you have to weigh, what's more important at the moment. Additional liquidity, more covenant flexibility, more um, unique assets that you can put into the borrowing base, whatever it is, versus cost. And that's
Yeah, so
probably
they
the
might be
biggest
like
difference.
3% or so more expensive compared to banks. But overall, I think ABL is pretty cheap, or the cheapest type of debt structure you can get. The lowest point would be around SOFR 200 from some commercial banks. And in some cases, for very large ABLs from larger companies or sponsor-backed deals, you can dip below SOFR 2 at times. I mean, right now the pricing is really, really low. Um, um,
That's right.
and it's covenant light. I mean, those are kind of two clear advantages for ABL to the extent a company does have sufficient amount of assets to get the type of financing that they are looking for.
That's right. Absolutely.
But on the other hand, there's going to be ongoing reporting. There'll be once a year or more frequent appraisals. You have to report your borrowing base monthly basis, let's say, or sometimes more frequently than that. So there's a lot of work involved in maintaining this, and then it can also probably pinch at times to the extent companies, working capital cycle turns are kind of slowing down and they do not have a lot of access availability, then they might be pinched for liquidity because it's a very formulaic way of providing capital.
Yeah, those are definitely some of the downsides of ABL that you hear a lot from borrowers that do it. So maybe shift gear a little bit. maybe ABL is not the best option because of some of the things you laid out, or
Yeah.
the company itself just doesn't have the asset base to really do what they want to do from a debt capacity. What Maybe talk a little bit about the cash flow option and what makes a good candidate as a borrower, what do lenders look for, that sort of thing.
Yeah. So let's say business services companies, which might not have inventories or might not have a lot of M&E, but have consistent EBITDA, decent amount of EBITDA. So they can leverage their EBITDA and get cash flow structures. At times, there could be asset-heavy companies, manufacturers, et cetera, which have pretty healthy margins, great EBITDA, consistent EBITDA, and they can obtain cash flow financing and go well beyond the value of the assets. So in either one of those cases, cash flow structures are really interesting. And I think the best feature of a cash flow structure is if you have sustainable enterprise value, then it's kind of the best way to monetize the value of your company and get the highest amount of debt capital you can get. And at times, it can help, especially middle market companies or smaller companies that are not really in capital markets all the time. It can help them at times replace, potential need for equity capital because there are so many non-bank lenders available. They'll end up providing higher leverage. So that's kind of the best advantage or kind of most relevant use for cash flow structure to kind of monetize to the best of the company's ability.
Yeah. And what maybe describe a little bit the landscape of who the lenders are in that world, and
Yeah.
how do they approach the market differently?
Yeah. So almost all commercial banks would apply, would do cash flow loans, but not all companies would be qualified for cash flow loans. So kind of first thing we need to discuss is, okay, every company has an enterprise value, every company has EBITDA. What is kind of the threshold where it becomes interesting or applicable for cash flow structures? So for most banks, a company needs to have, 8 to 10 million of sustainable EBITDA. That's kind of the cutoff nowadays for most of the banks. It's kind of the rule of thumbs. Obviously, there are exceptions. There are some non-bank lenders, SBICs, et cetera, that might end up doing cash flow deals for companies with EBITDA lower than that number. But the size of EBITDA is really, really important because that's one indicator or kind of early filter that lenders apply, because higher the company, higher the EBITDA, it indicates the company has a little bit more cushion in its cash flow to withstand some of the unpredictable bumps in the economy or in the business. So if the EBITDA is really small, they have much less cushion, and that increases the risk that company will survive. So that's kind of the very first cut, the size of the EBITDA. So commercial banks are obviously a big provider of this, but they tend to be conservative primarily because of their outlook and the way they need to operate their business, and secondly because of regulations. So almost all commercial banks, when they do cash flow transactions, typically they would lend no more than around 3 times EBITDA. That would be the amount that they can lend, and they would restrict the total debt to EBITDA ratio in a company at around 4 times. Again, there are exceptions to rules because every bank has a portfolio and they can do a couple of deals that can go beyond these thresholds. But on average, they would prefer to be under 3 times, and smaller the EBITDA, uh, farther below 3 times they want to be. So that's kind of one way to think about that. But then there are probably hundreds of non-bank lenders that have cropped up over the last 15 years, many, many credit funds that end up doing many of these cash flow structures, and they are not regulated. They do not have any, regulatory requirements. So they approach risk on a very fundamental basis. So they may say, this company, while bank can give 3 times the leverage or 3 times EBITDA in that amount, we can give 4 times or 4.5 times. Again, depending on the credit. But the way to look at that is typically banks would want to be around 50% of the enterprise value, not much more than that. Non-bank lenders can go all the way up to 70% of enterprise value. So if you're, let's say, for round numbers, if the enterprise value of the company was around 8 times, a non-bank lender can give about five times, 5.5 times leverage at max for the right condition, for the right company and right sponsorship, versus a bank would, always stop at around 3 times. So if you wanted more capital, then non-bank lenders can provide that for a particular cost.
Maybe give a sense of the costs of a commercial bank cash flow
Yeah.
versus the non-bank.
So commercial banks, I mean, not that far off from the ABL structure, because again, when they do end up doing cash flow deals, they feel as comfortable as most likely they would feel with an ABL structure, but a little bit riskier than that. So they typically start around, SOFR 3 or something like that. For non-bank lenders, the range is pretty broad. For very large transactions, large private equity sponsor-backed deals, they can go as low as, so for 450, so for 5, something like that. But most of the middle market transactions, the pricing would be somewhere between, so for 6 to so for 8. So more expensive, 3 to 5% more expensive compared to bank money, but you may end up getting, much more capital in return. And at times that capital that you get from non-bank lender, although it's few percentage more than what you would have paid to bank, it might be much cheaper compared to a company going and raising equity in order to have the same amount of capital.
Yeah. Are there other things beyond costs that folks should be thinking about when they're trying to structure a cash flow loan?
Absolutely. For example, a lot of non-bank lenders would have, pretty strong prepayment penalties. So you want to think about, well, how long do I have to be in this relationship and keep paying these rates? Another important thing to think about is amortization. Your cash flow loan, you're relying just on cash flow. Almost every bank structure would have, 5 to 10% amortization per year. So that's kind of required. For most of the non-bank lenders, there will not be much amortization, if any. So if you want to preserve the cash flow for reinvestment in the business or for any other reasons, then probably non-bank structures would be better. And then there are lots of other parts of the credit agreement, and we probably need to do another webinar for that. Lots of different restrictions that come into how the cash is being used, how the cash is being transferred within the company, et cetera. And all those things play a huge part in deciding, which structure to go with and what type of lenders to go with. Another thing to think about is the, financial covenants compared to ABL. Cash flow deals, while will not have a ton of, ongoing maintenance and ongoing reporting requirements, except for monthly and quarterly financials, they'll have more covenants. So they'll have leverage ratios as covenants, senior debt to EBITDA and total debt to EBITDA, and then fixed charge coverage. So those are kind of 3 classic covenants, so that, will be measured on a quarterly basis most of the time. So that has to be reported, but otherwise it's a pretty low maintenance type of financing.
Yeah, that's helpful. Lots to think about when you're putting your financing cap on in terms of what's better for the company, cash flow or asset based. And there's actually a structure that combines the two that
Yeah.
we should talk about as well.
So, I mean, this one, you can do cash flow deals, but as we said, low maintenance, but only negative is that it could be expensive. So then how is there a way to do cash flow deals, primarily rely on the cash flow deal, but still reduce the overall cost? And that's kind of the hybrid structure you are mentioning, Scott. So probably one way to do that is, let's say you go to a non-bank lender and get as much capital as you can on a leverage or cash flow basis. Then can you also bring in a bank for a piece of that financing, which is the bank cost or lower cost of capital? And that's kind of the structure that we can talk about. So one of the first one is a bifurcated structure, the split lien structure, as we call it, right? So, and this is suitable for companies that also have a lot of assets, but they also have, recurring cash flow. So what they can do is they can give the current assets to a bank and structure an asset-backed financing, much cheaper rate, right? And then remaining collateral or all the other assets they can give to a non-bank lender, and based on that they can get a leverage financing. So they can get a split lien term loan from from a bank, but might not be suitable for all the borrowers. So which borrowers should think about that?
Clearly, companies that have both, right, an asset base and a reliable, dependable cash flow, and um, that's the first consideration. The other thing I would say is that there's not all lenders offer this sort of hybrid structure. It's probably a little bit thinner market.
Yeah.
Some banks don't want to work in that capacity, but there's definitely a market for that. And if you have the right characteristics of your company, you could end up getting more capital than you would in an asset-based deal and at less cost than a cash flow. So you're kind of getting the best of both
Best of
worlds if
both
you can put
worlds.
it
I think
together.
there's probably more depth to this type of structure because a bank is getting a distinct collateral pool. They are not sharing the lien with other non-bank lenders, and they're just doing a straightforward ABL on current assets. So there's, you can find lenders to do this, but then there's other variation of the same thing. For example, business services companies that might not have a lot of current assets to offer to lenders. So we can bring in a bank to do a cash flow structure as a first out. So they'll share lien on all assets with a non-bank lender, but they'll have the first payment priority. So they can get repaid first. And for this structure, as you mentioned, Scott, obviously the market depth is a little shallow because not all the banks want to share the lien on the assets with a non-bank lender, so that fewer banks would do that. But if you end up doing that, then the structure is a bank comes in, gives you a smaller line of credit and gives you a smaller first out term loan. And behind them is a non-bank lender that gives you a much larger term loan, and they are on the last out basis. And then there's an agreement among the lenders, there's an intercreditor, et cetera, that governs how money flows between the first out or the bank and the last out, which is the non-bank. So it's a complex structure, but when you combine these two, the cheaper cost of debt from bank ends up subsidizing the more expensive debt coming from the non-bank lenders. And when you combine the two, you maximize your debt capacity.
And I'd also add that this sort of first out, last out structure, there are particular banks and non-bank lenders that like it because it's advantageous to them and how they operate their business. So they have, while it is complex and there's, agreements among lenders and other things, there's firms that have a lot of experience in this and make it execute as well or almost as well as a traditional cash flow facility. So it's don't be scared away by some of the downsides because there is good execution in that market, although it may be a little bit of a thinner market, as you said, than a traditional cash flow and ABL world.
And from economics perspective, why we do not have the line here, but basically it can reduce the overall cost of non-bank financing by combining the bank financing in the front. Overall financing cost can go down by 1% or 2%. And it might end up allowing you to monetize your assets much more efficiently. So you can maximize your debt capacity. Cost could be higher than a pure bank financing, but lower than a pure non-bank financing. And as you're maximizing your debt capacity, you might not have to raise equity in, let's say you're making acquisition, et cetera. You can finance the full acquisition through debt. But on the other hand, you're negotiating with, two sets of lenders. There'll be, quite likely two sets of lawyers, and legal fees can add up quite a bit. So there's some negotiation involved, and then, you need some sophistication to deal with this. So it's definitely more complex structure, happens all the time. And obviously we can help in something like this as well, but it's a great way to get higher amount of capital for companies that have not explored this option. So it's a great option available to everybody. After this webinar, if you have any questions as a follow-up and you wanted to reach out to us, you can write to me directly, Rocky at CAPX, and we'll come back to you. We'll also post this webinar and online, and we'll send you the links. So for your reference, if you wanted to refer back to something, as well as this presentation. So thank you for participating today, and we look forward to working with you all.
Thank you.
Thanks, Scott.
You're welcome.
Okay, talk soon. Bye.